Hey, what's up, traders? This is Tim Reset from eMoneyMind.com, bringing to you another webinar. Today's topic is trading the ES on the 512 tick chart. Now, this is something that I've talked about before. I've touched upon in other webinars. We've talked about the 512 tick chart a lot on the 6E, but I wanted to bring you some insights that I've been trying to quantify a little bit more as of late. So some things that I've seen occurring quite a bit on the ES intraday, and some ways that I look at the 512 tick chart a little bit differently than some of the other time frames. So I think this webinar will be really helpful if you like trading short time frames, you like being in and out rather quickly without a lot of noise or pullback in between, or perhaps you don't have a whole lot of time to trade, so you're just looking at the morning, hour or 2 hours of the morning on the ES, and that's all you have time for. And so this can be a pretty viable strategy. So let's jump right in. As you know, that trading does carry a high level of risk, and you're subject to lose all or more of your original investment, so don't trade with money you can't afford to lose, or money that if lost would affect your current lifestyle. The information in the presentation is for educational purposes only and is not intended to be financial advice. The purpose of the webinar is to help you better understand the markets and improve your skills as a trader. I believe a balanced life leads to a healthy life, and our attitudes influence our behavior. Trading is a small but meaningful part of the bigger picture. So number one is, why trade off the smaller time frame? Well, when you go with the smaller time frames, you're essentially going with the short-term momentum, and oftentimes these are quick counter trend trades, and the trades occur at higher lows. So those are the kind of two criteria we'll be looking at for the ES. When you look at a smaller time frame chart, there's obviously a lot more trading opportunities. So what you need to do is kind of screen out a lot of the noise, and this is one of the best ways I've found to do that on the ES. So I'll be looking at a small trading window, and that'll be the 9 o'clock to 10 o'clock time frame, and that's Central Time. And really, I think the hardest part to this style of trading, or trading in a very small time frame, is you kind of have to disregard the larger time frames, because just because we might be in an uptrend on a daily chart or a 15-minute chart, it doesn't mean that we can't be in a short-term opposing trend or counter trend move on the smaller time frames. So we'll talk about a few ways that you can utilize the smaller time frames without taking into account the larger time frames. And you can also use this style to enter the gap fill. I do have a webinar in the member dashboard specifically talking about the gap fill, and it uses this similar style of entries. So the trade setup in itself, we will be looking at buying and selling 50% retracements, and we'll be looking at highs and lows of the day. And that's something that's rather important, and I have some examples here in a couple of slides. So the entry criteria themselves, I have a chart that kind of breaks down what I'm looking for, but it really needs to be visible on a 512 tick chart, as we have in front of you. This is a 512 tick chart with the Heikin-Ashi candlestick study on the ES. We need to have a break of the prior swing high or swing low. In this case, we're looking for a long setup, and we break the prior swing high, and we have a stop loss of less than 6 ticks. And the way you get your stop loss is to look at the distance between the 60 1/8 and the 50. So in this case, I will use the 50% and put my order 1 tick in front of that, and put my stop order 1 tick below the 60 1/8 once I round. So it's pretty tiny down here, but the 60 1/8 is at 84 cents, so I will round down to 75 cents and then add a tick at 50 cents. And then you want your risk to reward to be, ideally 1.5 or better. So if you are risking, uh, you know, 4 pips, 4 ticks on the trade, that is the distance between your entry and stop, as we have here. For example, we'll use 6, but so in this case, if your distance between your entry and your stop is 6 ticks, it would be nice to have a target of 9 ticks. Now that's not always the case, but you certainly want to have a risk to reward of at least 1 to 1. Ideally 1.5 to 1 or greater is better. So you'll find that with this style of placing your entry 1 tick in front and your stop rounding down and a tick below, you'll end up with trades that have, a risk of 3 or 4 ticks, but have profit potential of 6 or 8 ticks. And again, those are short-term, very quick moves. You can see here a nice run from the entry right to the target without any, wiggling in between, with a lot less noise than you see on some of the other time frames. Talk about some of the trading rules that we have now. If you're using only a couple of contracts, I think that's the best way to go with a strategy like this on the smaller time frames. The larger the time frames, the larger the time horizon, and the larger the position that I think is necessary to build a base or a core position. As you get to smaller time frames, I think it's beneficial to trade smaller number of contracts. So if you are using 1 or 2 contracts, that's great. The time frame we're looking at is the 512 tick chart. The entry will be 1 tick before the 50%, and actually that'll be tick, not ticks. 1 tick before the 50, and I will only round. So as I mentioned before, if we're at 1531 and I'm looking for a long, I will just round to 1550. So I won't round and add a tick, I will just round only. And then for the stop, essentially 2 ticks outside of the 61/8, but what we're doing is rounding down and then adding a tick. And then you want to take all the setups with favorable risk to reward. Again, 1 to 1 at least, but 1.5 to 1 is a much better situation to be in. And then just simply passing on the other trades that don't meet your criteria is what you want to do to kind of screen out some of the noise. As for profit targets, I'll use 1 tick before the -23. Again, just rounding, not rounding and adding a tick. And then for trade management, some of the options that you can use, you can go all in, all out, which is beneficial on the ES because you do have a lot of chop and a lot of noise that occurs and a lot of bouncing around, especially at entries. So if you immediately go to break even, you can get taken out before the trade even moves in your favor. So the trail stop, couple techniques. You can trail the 61/8 of the next small 512 setup. You can trail outside of swing highs and swing lows, something I really like to do because it's a little bit more, it's a little more specific to the chart itself. It's a little less arbitrary. And then optionally, you can move your stop to break even once a new high or low is made, but again, you risk the risk of getting taken out before your profit target is hit. And then finally, if you're using 2 contracts, you can exit the first one at the -23 and then trail the second if you want. I think it's important to take profit at that target, at that -23% level, but if you do have 2 contracts, you can trail the second one. We talk about the NYSE tick a lot here on the blog, and one of the things that you can do is look for a high tick that lines up with the high price of the day. And when we get a high tick that lines up with the high price, it could potentially be the high of the day. It doesn't necessarily mean that it will be, but a lot of the times there will at least be a short-term reversal, and that's what we're looking to capture here. So if we compare our tick chart high to the high price of the day, and you can set alerts so you can get audio alerts and things like that. And so when the high tick lines up with the high of the day, simply waiting for that break of the prior swing low to take a short. So when we have a high tick at the high, we're looking for a short. When we have a low tick at the low, we're looking for a long. So the tick on the left and the ES chart on the right shows that we have a high tick at the high of the day that corresponds with the high price of the day. We start to sell off a little bit and we break the prior swing low, which I'll touch on in the next couple of charts as well. Then we rally back up, and that's where we place our short, and we look for a target down to negative 23% level. The other thing that's important is to outline the first 30 minutes of the day. Now, as you know, I don't trade the first 30 minutes of the day on the ES because it can be rather choppy. Now, this chart in particular looks pretty clean for the first 30 minutes, but it's not always the case. So I will mark the low and high for the first 30 minutes of the ES, that's 8:30 to 9 Central Time, and then that gives me a reference point. So as you can see here, at about 9:10, we broke highs, and then we made our retracement back into the first 30-minute range. And this little double top here, this move to highs, where we sell off back down to the 30-minute high, 30-minute range high, we break the prior swing low, and we have a nice short setup over here at about 9:15. And I'll zoom in a little bit, and we'll take a look at this setup a little closer. So on the right is that double top pattern that we have right back here. So I'll talk about that first. We have this little double top pattern where we break the swing low. We form a lower low here that breaks the prior swing low. We have the double top, and then that just initiates a sell because we're at highs. We're looking to short. And the break of the prior swing low is very important because that signals that there is a short-term reversal. And that's where we place that's when we get the signal to draw up the short, place our entry limit order one tick in front of the 50, and then our target down at the negative 23. And then again, if you're using two contracts, you can trail the swing highs as we have here as we move lower. So that's the double top pattern that you saw back here. Again, this is the 30-minute range being outlined, and this is a reversal at highs that takes us down back into that range. And then on the left chart here, we just have another example of breaking the prior swing. Now, this is a situation where you have just a one-bar pullback, but because the pullback is on the uptrend, I consider that a swing. So we have a swing low here, we have a put in a high, put in a higher low, put in another high, and then we sell off, and this low is lower than this prior swing low. And because this occurred on the upswing, I count that as a swing. So, and I count that as a break. So then simply drawing from highs to lows, we get a 41 entry that takes us down to the negative 23% target. And then finally, before I move into the live charts I'll pull up in a minute, let's just talk a little bit about risk management. So for a max loss per trade, I'll use 6 ticks as my maximum, and then 2 contracts would simply be 12 ticks. For a max loss per day, again, that 2 stop out rule. So if you have 2 stop outs on the ES done for the day, and because you're trading in such a small window, the likelihood of this happening is very small. But again, having these loss limits in place is very important. And then some goals you can set for yourself. You want your average loser to end up being around 3 or 4 ticks. With the using a smaller time frame, the benefit is your risk can be a lot smaller, so you end up with an average loser that's much smaller than it would be on a larger time frame. Then your average winner ends up being around 6 or 8 ticks. So those are the kind of metrics you want to shoot for. And then winning percentage, 60% or greater. This style of trading where you can use a very tight stop allows for a nice 2-to-1 or so risk to reward to risk ratio, and with a high winning percentage, or with a winning percentage that is greater than 50, you can really see some nice gains in this kind of style of trading. Now, you don't have many trades per day, only a couple trades per day, but it does, I find, keep you out of a lot of the chop and a lot of the noise that occurs. So, just another tool for your toolbox, something to consider. I thought what I'd do now is just take a run through this last week and go through some examples. So I'm going to flip over to my chart, and currently today, it's Thursday afternoon. First thing I'll do, so I have trading hours only on. That way, just gives me a little bit less data here when I'm going through the chart. So the high and low for this morning ended up being the high and low until about 15 minutes ago. Now it's about 11:30 Central Time, so I'm already done trading, day trading this morning for the day. So we did finally got a break. And if this were within trading hours, or within my time window to trade, we did get this break of highs. We came down, we broke the prior swing low, and the short setup would be up here at 44s. But for the morning session, I was looking at, this is what I had to work with today. And as you can see, we just chopped around all day long. Now, if you were looking on the 512 chart and taking every little setup, you'd have a handful that work, but you have a handful that end up just getting you stopped out or not going all the way to their targets. So I think it's important to limit the number of trades, and the best way to do that I've found is to mark the highs and lows of the first 30-minute range and wait for a break outside of that range. So no trades today on that particular setup. If we go back to Thursday, mark the low, and mark the high. Now Thursday, the high can occur within the first 30 minutes. So Thursday we had the high right about at 9 o'clock, just before, and then we came down, and immediately, just after 9, I think it was 9:02, I got filled. The order here broke the prior little swing low that we have here, and so since the high that our anchor point is using is the high of the morning, I consider that valid. We want to be up near highs or down near lows. We don't want to be right in the middle of the range. That's the main thing. So simply when we broke the prior swing, both this little swing up here and down here, so we broke the prior swing low. So we're looking at, since we're at highs, we're looking for a short, and so it was just a matter of drawing from highs to lows, putting our order one tick in front of the 50 and targeting the negative 23. You have to be kind of quick on some of this stuff because this was in a matter of only a couple minutes, so you do have to kind of be on the ball. And I have alerts, audio alerts set up as well from my tick chart that ding, so that I can, if I'm not looking at that chart specifically, I can move back over to it. But you do have to be kind of quick, and you want to be make sure you're executing effectively. So that was Thursday, and then we came down here and made a low. This is Wednesday, rather. Came down here and made a low at 9:40. Now this is one of those instances where we didn't break. So this is the high right here, and we did not break a swing high on the move down. We have this little consolidation and this little swing that occurs, But these can be a little bit sloppy, so I really like, see how this move up has these pullbacks, and these are the swing lows that were taken out and then moved down. Well, this move down, the pullbacks are here and here, and even though they're really small, and we didn't break those. So even though this trade did work out, I find that they can be a little bit less reliable. So that's just one thing to consider. And then the last thing we had here, we had another low right at 10 o'clock, and this was a super tiny setup. Again, it did work out, but keeping your risk to reward at the forefront is important. And if we go back to Tuesday, so you can see not very many setups, but that's okay. You have a couple different styles or strategies that you're looking at, and a couple different markets, and next thing you know, you have a whole basket of trade ideas that you can pull from throughout the day. So it's not about maximizing the number of trades, it's maximizing the consistency over, multiple markets, multiple trades, and things like that, or multiple markets and multiple trade strategies. So, whoops, the high for Tuesday was here, and the low was down here. And so we made this high on Tuesday, and we didn't break any swing low. The swing low was down here, and we just double bottomed. We didn't break it. So for that reason, trading this way, you'd say, well, counter trend, aren't you going to get taken out a lot and be shorting in strong rallies? Well, for this reason, waiting for that break of the swing low, you only end up shorting when the short-term momentum switches, or if we're very bearish in the day, trending lower, you only end up taking a long when the short-term momentum switches to be bullish. So the first setup that was really small, or the only setup that occurred, it was really late in the day, right at 10 o'clock, and we had swing low, swing low, swing low, and we finally break right here. Now you can see we have a low and then a high of the day at that point, because we're about right here. So this is the swing low on the way up, and this is the swing low on the way down. So for that reason, I'll wait for this swing low to break, which it did, and we made a small pullback with a 1 point target on that one, which went down, hit its negative 23. So only very small risk, like I said, 3 to 4 ticks, and profit targets on, especially on these small ones, end up being pretty small, 4 to 8 ticks. But the point here is to be consistent and keep that risk to reward in favor, and keep that winning percentage rather high, and that's what makes the strategy very, very viable. And so that took us to the end of Tuesday, and then Monday, low and high. Again, we have a sell-off. We didn't break the prior swing low. We broke the prior swing low on the way down. So this is the swing low on the way up, and this is the little swing on the way down. Now we did have a high tick of the day here at 854. So if you were to take a short, it did go 1 tick into the 61.8, but that's why I round up and add a tick to give me a little bit of cushion. So the trade did end up working out, but we didn't get a very definitive break here at the low. In the next trade, we had a break of highs. We broke the prior swing low. We had another short setup. And again, if you're using 2 contracts, you can take the first one off the target, then you can trail 61/8 all the way down, or you can trail the swing highs all the way down. So there is more profit potential than just between the 50 and the negative 23. And as of late, we've had some pretty low volatility, so these ranges have been pretty small. But there can be larger trades where you have a 4 or 5 pip stop and a 3 or 4 point target. So they certainly do exist. We're just seeing, a little bit smaller and lower amounts of volatility right now. And that took us to 10 o'clock. So the 2 trades there, or the 1 trade there rather. And then going back to Friday, marking the low and the 9 o'clock. 9 o'clock is here. So here's a situation where we break highs, but we don't get that double top. The double top would be very important to take that short order, a definitive break of the prior swing. So here's the swing low on the way up. This is the swing low on the way down. And we don't have a double top as we did on Wednesday of this week. So that makes this trade not valid. The next trade here, we have this double top. We make a new high, and then we get the double top. So that makes the swing low valid. We can pull from highs to lows, and again, shorting at the 50, target at the negative 23. If you have 2 contracts, you can trail 61/8 all the way down. And then we did end up reversing and moving on higher for the day. And the last day here, Thursday, 8:30 low, high for the day. As we move, so in this case, the high for the day did not get taken out until later in the afternoon. So one thing we can do is identify the prior swing, which is back here, and the first time that swing was taken out is over here. On this specific, if we draw from highs to lows, we don't make it up into the 50. So if we pull to the next low, we do get a pullback. We go in by 1 tick, but it doesn't hit our stop. So this is a case where it's a little bit bigger micro and a little bit bigger setup on the 512, but this is the first setup where we use that high as the anchor point, and we end up coming down, breaking the prior swing low, and then we do have a nice profit target that runs all the way down to the negative 23 on this setup. So, if the high of the day ends up being at a high tick, or if the high of the day is within that first 30 minutes and we make a definitive break, you can take those little bit larger setups in between there. The point is you're trading around highs and lows of the day and looking for, only a couple of trades during the day. But as you can see, not a whole lot of losing setups that occur. But it's just, the frequency of the trades and the risk to reward is what makes it really important. At the end of the day, the entries themselves are a lot less important than the exits, the risk management, and the managing of the trade. So I hope you found that webinar helpful. Again, just another tool for your toolbox. Some of the things kind of have some overlap on the ES and the 6E, especially with the swing lows and swing highs and those breaks and things like that. Some of the other webinars you may be interested in are the gap fill webinar, the identifying the trends webinar. Those may help clarify a few things as well. So with that, I hope you have a great rest of your day, and we'll talk to you again soon.